Okay, well, hi everyone. Welcome to another Port Jackson Securities webinar. I'm your webinar host, Caitlin Chung, and today we're joined by CEO of ServiceStream, Leigh Mackender. Thank you so much, Leigh, for joining us. Sorry about the technical difficulties, everyone, but we're here now. And today, Leigh will take us through a quick presentation, and then we'll go through Q&A. So feel free to pop your questions into chat, and then we'll go through them after. But I'll hand it off to you, Leigh.
Thank you, Caitlin. I appreciate you hosting us today and everyone for joining. So as for the introduction, I thought I'll just touch on a couple of key messages in terms of the full year results, and then happy to move into Q&A. Not knowing how much the participants know about the business, I thought I'd just probably start with a very brief overview of ServiceStream. For those not familiar with the business, ServiceStream is an essential network service provider. We design, construct, operate and maintain essential infrastructure on behalf of government or major industrial asset owners and operators across the country. We have three strategic business units reflecting our reporting segments. They are telecommunications, providing fixed and wireless services across Australia. We also have a utilities division, which focuses on providing gas, electricity, water, new energy and industrial service related support for our customers. And we have a transport division which primarily focuses on the delivery of road infrastructure services. So just quickly move through the presentation for our full year results, and thought I'd just probably start on the key messages slide, and this probably provides a good background to the results for the year. We've reflected on FY22 as a pretty significant and almost transformational year for ServiceStream. I don't use that terminology often, but I think it is appropriate considering the size and scale of what was undertaken over the last 12 months. So, of course, conscious headlining that was the acquisition of Lendlease Services. The acquisition we announced in July last year, successfully completed in November, and have been integrating over the latter part of FY22. That was fairly significant for our business in terms of the size and scale. It effectively doubled the size of ServiceStream in terms of our revenue, in terms of our employees, our contract base, etc. It enhanced our capabilities, so it gave us more capabilities to target new markets, and did expand us across some of those new markets, such as transport, more deeply across the electricity industry and utilities, and also the industrial markets in the utility segment also. In terms of financial results for the year, the headline here is one of our key metrics is EBITDA from operations. That was 91.1 million. A solid result, but it was impacted by a solitary issue in our utilities segment, which I'll talk about later on, one major project that was a trial for the business. The business has always generated really solid cash flow from our operations, and this was, again, something that I think is a standout for this result, converting our EBITDA to OCF bid at 108% over the full year. Business finished the year with a robust balance sheet, and the board were very pleased to announce the resumption of dividends after a 12-month hold to support the acquisition of Lendlease. In terms of the acquisition of Lendlease, that's gone really well. So a lot of the focus for this year has really been on the integration of those businesses and the delivery of the synergies that we announced of 17 million when we completed the transaction. One of the major milestones was exiting from what we call the transitional services agreement, and that effectively was the agreement with Lendlease Group, the parent entity, to provide back of house support for finance, HR, people and culture related services, processing, payroll, etc., and IT. So being able to exit from that agreement on 30th of June has really enabled us to then hold all of the systems, the processes within our business, and then we can start to integrate through the second phase of the integration program, which will be concluded this financial year. In terms of synergies, we announced 17 million of synergies associated with the transaction, and very pleased to see that the progress is actually ahead of our original forecast, both in terms of time and quantum. So in this result here, we've delivered a run rate of about 10 million in synergies, 6 million of which has hit the P&L by June 30, and we're very confident of delivering the final 8 million over the course of FY23. And I think in terms of the underlying performance or the profit of the business over the 8 months of our ownership, it has certainly met the expectations that we had during diligence, and has performed well over that period. I think a couple of other things to probably note in terms of the year. The business has got a very strong work in hand balance. I'll flick to slide 6, which provides a bit of an overview of our work in hand. It's a key metric for contracting businesses like ourselves. As I said, have about 140 odd contracts across the business. Our work order book has increased to just over 6 billion at the close of 30 June. That equates to about 3.5 times our FY22 pro forma revenue. And during the year, we secured about 1.5 billion. So really strong contract revenues over the next couple of years. And really pleasing to see about 85% of that is secured for this year. So we do have some work to do. We always have a portion of work that we need to secure throughout the year, bidding and winning on certain contracts, but we do start the year in a very favourable position. And we've provided some details on this slide here, which break down that work in hand by our markets or our segments, and also by the type. And you can see there, 80% or just over 80% of our work is either schedule of rates or minor capital work, so a lower risk style of work, and about 80% of that work in hand is held with either federal or state governments. The remaining portion is with large industrial customers. Probably the other thing just to note in terms of headlines, and it's very topical given the current environment, is inflationary pressures. I was really pleased with the business's performance over FY22, despite having some challenges with regards to wage inflation and operational costs. We were able to offset 100% of that throughout the year through various mechanisms. We're either passing that back up through our clients, through some of the mechanisms we've outlined on the slide here, or able to find other operational synergies across the business to offset some of those increased costs. To provide some insight across the group, about 87% of our revenue is subject to either an adjustment mechanism or is priced on application for works that may be completed over sort of a 3 or 6 month period, obviously taking into account the current environment. As I said before, the majority of that work is lower risk schedule of rates or annuity style works, and any of that sort of minor capital works or D&C works is generally less than 12 months in duration. And we've outlined some of the insights across our 3 business units here in terms of those specific measures that we have to enable us to pass some of those inflationary costs back onto our clients. So in telecommunications, 85% of our contracted work is subject to an annual review, where we sit down with our client, we review all of our rates, upstream, downstream, overheads, etc., and they're adjusted accordingly. Utilities is far more prescriptive. That's 95% of our agreements have a specific metric or adjustment mechanism that it's aligned to, such as CPI or WPI. And in transport, we have about 70% of our work, which is subject to either a quarterly or an annual review. And those that are outside of that, we're obviously a longer dated contracts where we have priced in escalation assumptions. So I think the other point that, as I said, has been very topical throughout our roadshow has been the business's ability to deal with some of those inflationary pressures. That's probably it in terms of the key insights or highlights from myself. I'd be happy to take questions, or I can continue through the presentation if we don't have any questions from the group.
No, I think that's a really, really good introduction to ServiceStream, especially to those that are unfamiliar with your company. I do have a few questions. And to anyone that is watching, feel free to pop up your hand or put them in the chat. But I know, can you tell us more about Connect Sydney? I noticed that it's a project that you guys are doing right now, but yeah, could you tell us more to the audience that may be unfamiliar?
Yeah, absolutely. I'll just flick over to the relevant division, which is our transport division. So as you see here, our transport division has a number of contracts. We have about 10 different agreements with clients across the country, and Connect Sydney is certainly one of those major agreements. That's a 15-year maintenance agreement where we're maintaining all of the road infrastructure or transport infrastructure assets in what they call the harbour zone. So effectively, the New South Wales government has split New South Wales into effectively 3 regions, and we're responsible for the management of the road, traffic lights and other infrastructure right down to the median strips for that 15-year period. So that's been certainly one of our key or marquee contracts across the business. When we acquired Lendlease, the transport division is new to ServiceStream, so that's why we don't have any revenue in FY21. When we acquired the business, this was just mobilising. So that Connect Sydney contract is now just reached its first anniversary. So really pleased to see that we've been able to mobilise despite COVID challenges, and it's now sort of running at a steady run rate.
And what's the revenue split between telecommunications, utilities, and transport?
I'll just flick back again, sorry to move around, but I can show you our revenue split here if we look at our profile. So we've provided some insight on slide 5 of the presentation, which just provides that greater detail of the revenue split. So as you can see here, about 43% of our revenue is associated with utilities. So that's gas, electricity, water, industrial services or renewable energy related services. 41% is telecommunications, both fixed and wireless. So we've got agreements with all the major carriers, NBN, Telstra, Optus, Vodafone, TPG, etc. We're providing services to either design, construct or maintain the telecommunications infrastructure across the country. And 16% is transport. As I said earlier, that's probably about 10 key contracts across our transportation division that are held across the country, some in WA and majority though on the East Coast. Again, the services are really associated with maintaining road infrastructure. That includes things such as managing the control rooms, so actually monitoring the freeway traffic in the control rooms, responding to emergency events, and also undertaking some of those preventative or program maintenance related tasks as they're required across the asset.
And I noticed across your social media that you guys are really involved in the local communities that you guys work in with volunteering and sponsoring some events. What are some highlights from this past year?
Yeah, certainly we do play a key role in engaging with and supporting local community. I've just moved to the sustainability slide here and note that for those interested, our sustainability report was released on 1 September. So we've outlined our performance across our 5 pathways that support our sustainability strategy. Those pathways here are health and safety, environment, people, community and governance. And those are 5 areas of focus. Those 5 areas of focus are really driven through a materiality assessment we undertook with all of our business stakeholders to really understand, given the type of business we are, what and where should we be focusing in terms of our sustainability efforts. Community, as you said, is a big one for us. So what we focus on here is how we can engage local trades, how we can engage local people for our workforce, our employee workforce. We use about 5,000 contractors, skilled contractors across our business. So whenever we have a particular contract or operation, we generally try and look to utilise that local labour. And again, local trades, for providing specialist services, but also local suppliers in terms of equipment, if we do need to supply any equipment or materials. One of the other major initiatives from a community perspective has been our work in supporting First Nations, and we're really pleased to, we're just finalising our inaugural Reconciliation Action Plan. We're working with Reconciliation Australia to go through that and have that released certainly over the next quarter. And that's really, I think, a significant achievement for our business on the back of the work we've been doing in supporting Aboriginal and Torres Strait Islanders to provide services to our business and look to engage them either as, again, employees or contractors across the business. So that's certainly a couple of the aspects that we're focused on in terms of our community engagement.
And what are all the projects that you guys have ongoing at the moment, and what's on the pipeline for the rest of the year?
In terms of projects, there is a lot. So in terms of our contract base, ServiceStream primarily is a service provider, has long-term contracts. The contracts we have in our business, I said before, circa 140, 150 different contracts where we're maintaining infrastructure on behalf of major asset owners. So those contracts are generally a 3 to 5 year term, but our business has had a great success in renewing those despite that 3 to 5 year period, and our retention rate would be in excess of 20 odd years for the majority of our contracts. So projects and such is probably not the right way we think about the business. We've got a lot of long-term contracts and our contracted revenue and pipeline, as talked about before, work in hand at about 6 billion, which means we've got about three times coverage. Some of those contracts do support the delivery of specific projects. So say in water or gas infrastructure, we'll be on panel arrangements where we're working with some of the major asset owners, and some of the smaller projects we'll be undertaking could be to upgrade water infrastructure, upgrade sewer infrastructure, gas infrastructure networks. They're generally sort of 3 to 6 month period of time, $3 to $5 million projects. So they're small projects across the business is typically what we see in terms of our revenue mix. And I'll just pull that up here on slide 6 here. You can see that work in hand. O&M, minor capital works, is the bulk of that, 80-odd%. And then you have 18% of our revenue is derived from design and construction type activities. 1% fixed price lump sum, obviously given the risk associated with those works. That's an area where we are conscious of our appetite and what we want to take on in terms of risk there. We have about 16%, which is through an alliance or a target cost model, which is long-term alliance contracts with asset owners. And we have a small portion, which is schedule of rates. So at any one time, we'll have 100-odd projects across the business underway, but they generally fall under that banner of sort of 100-odd, 150 contracts across the business.
That's all the questions from me. Do you have any more slides you'd like to show us?
Look, I think I'll just quickly touch on, if we've got no questions in terms of the content thus far, talk about each of our segments a little. Probably
I think Christopher has a question. Christopher.
Go for it, Christopher.
Yeah.
Yeah. Hi there. Can you hear me?
I can.
Yeah, we can.
Yeah, great. Thanks for the presentation, Leigh. Look, just a couple of questions. First of all, I think back in about February, you were still reiterating EBIT from operations of about 125 million.
That's correct.
And that then came out as an actual result at about 91 million. Is that correct?
So the guidance that we provided, Christopher, was 120 to 125 million. That was a pro forma number, obviously taking into account what we would have seen from a full 12-month contribution from Lendlease. We obviously only saw 8 months of that, and the full run rate of synergies. So if we look at the sell-side analyst reports or the broker reports, they had looked at the 8-month contribution from Lendlease and the delivery of synergies, and had us, I think consensus was about 93 million for FY22.
Okay.
Yeah.
Okay.
So we came in just under that. And unfortunately, the impact there was been that solitary project in the utilities area that I referenced at a high level. I haven't talked through the detail there, but we had, unfortunately, one of our utility projects that is a larger scale design and construction project, which is a part of a trial. And that's unfortunately had some cost blowouts on that, and we've had to take it up as an onerous contract. We've provided for that. It's fair to say we'll be pivoting away from those works given the current environment and the risk there. The majority of our work, as I said, is annuity style or maintenance related tasks. But that was what sort of caused us to be coming under that result. That impacted was probably about $10 million of impact, negative impact over the course of this second half. So you can understand we probably would have otherwise had a result that would have exceeded that consensus.
Right. Okay. So do you have a guidance for FY23 on?
No, we didn't release guidance 20. I've just pulled up the outlook slide here. We're very conscious that we will see continued revenue and profit growth. We will naturally see that from the incorporation of a full run rate of 12 months of Lendlease Services revenues and profit flowing through the business. So that will naturally increase our revenue and profit. What we were conscious of going into this year is some of the challenges that we've had. We've obviously just mentioned a couple of $1 million that has impacted us on that project. So we will not see revenue associated with that one-off utility project into 23. And there's a couple of other areas that we were cautious to. Our business has not traditionally provided guidance. We did in 22, given the transaction we're undertaking. And as per our comments here in the outlook slide, what we were confident saying is we'll continue to see revenue and profit growth. We didn't want to, at this early stage of the year, provide a firm sort of guidance or a range. but I've put down some details in terms of what we expect to see, and it had planned on updating the market at our AGM or our half year, just in terms of Q1 performance, where the business is sitting, and what we expect to sort of see for the full year.
Right. Okay. Fair enough. Just one other thing. Can you maybe talk a little bit about capital management, just dividends, buybacks? What I realize maybe it's not. They're not. Maybe not something you can really go big on right at the moment. But is there a sort of free cash flow threshold or something that would sort of lead you to be more assertive about getting funds back to shareholders?
It's a great question, Christopher. And over my time, over the last 8 years, we have undertaken a number of initiatives. So we have completed capital return. We have obviously increased dividends over that period before we held them for this transaction. And we've also undertaken buybacks. Our business generates very strong cash flow. As you see here, we had operating cash flows of 98 million. We have a blue chip client base, and it really is, I think, one of the key strengths of our business is that ability to sort of forecast out very strong cash flow. So the board were certainly committed to resuming dividends in the first instance, and that's what has taken place in the full year result, and expect therefore those to continue. We don't have a payout ratio that we've set across the business. That's something that we can consider and maybe make comment on into the future. But in terms of broader capital management, I probably think about 3 areas. We certainly need to be conscious of a debt position. So we do have some debt. We've outlined that we expect over the next sort of 12 to 18 months to get that down to about 1 times EBITDA. It's sitting just above that at the moment. Okay. But I think that balance between dividends, managing our debt position, and then also reinvesting into the business to support growth will be sort of the 3 aspects that we're certainly conscious of and juggling as we move forward. But we would expect to see dividends increase, and then we'll consider other initiatives. Certainly our business over the last 8 years, I said before, where we have surplus cash over and above our requirements, we have through a number of different mechanisms sought to return that to shareholders.
Right. Okay. Thank you.
Welcome.
Thank you so much, Christopher, for those questions. Does anyone else have any questions? If not, I'll hand it back to you, Leigh, if you have any closing slides.
No particular closing slides from myself. I think there's a lot to understand with our business. I think the presentation here is something that I'm sure everyone has probably had a look through, or if not, can certainly go through, and we'd be happy to have follow-up sessions with anyone if there's interest there. I think from my perspective, probably just some comments to close out in relation to what we'd outlined in our slide deck here. I think our business finds itself in, I think, a very positive state. Whilst we've had one issue in our utility division that it was unfortunate and did take away from what would have otherwise been, I think, a very, very strong result ahead of expectations. I think there's a number of positive aspects to our business. Certainly the strong contract order book, the work in hand that we have. We face some very attractive markets. Our key clients, our asset owners and operators across telecommunications, the utilities sector and transport are all looking to increase expenditure, and we therefore expect maintenance to continue to increase as a portion of that. I just talked about earlier the strong cash flow conversion, or strong cash flows that flow from our operations. I think that's another strength. We're in a good position in terms of that forecasted revenue for this year. We are conscious of some of the extreme weather and other impacts that have happened over the course of the last 6 months particularly. But I think our business is in a very strong position if we look to the future to deliver an improved result on what we delivered in FY22.
Yeah, thank you so much. I'm assuming this presentation is available for the audience to download off your site? This is available on our website, or it was uploaded onto the ASX on the 23rd of August. So certainly the presentation materials referencing that I've referenced today align with that presentation. And as I said, if anyone's got any more questions or would like to understand more about the nature of our business, the contracts, the services we provide, we'd be happy for anyone to reach out to Chloe and set up further discussion. Yeah, definitely. And for those that are rewatching this, feel free to email me if you have any questions, and I can pass them on as well. But thank you so much, Leigh, for joining us. Thank you, Chloe, for organizing the webinar. We're sorry about the technical difficulties once again, but yeah, it was really great to learn about ServiceStream and everything that you guys are doing.
No problems, Caitlin. Really appreciate you hosting us, and thank you for Christopher and others for joining. Appreciate it.
Okay.
Thanks, Caitlin.
Thank you.
Have a good day.
Thank you.
Thanks.